So we are carrying on the theme of in the shift in macro perspectives. What were the LP perspectives in terms of key market allocations? Moving on to understanding these perspectives from the private equity point of view, from experienced fund managers in terms of their allocation and a review of 2022 and outlook towards 2023. Now we move on to a similar theme, and we have Neelkanth Mishra. He's Managing Director, Co-Head of Equity Strategy Asia Pacific, Head of India Securities Research, Credit Suisse. He's joining us, and he'll take us through a theme of a resilient India in a turbulent world. So I would like to call upon stage Mr. Neelkanth Mishra, please. Thank you so much, sir.
Thank you. So the presentation will be projected?
Yes. Can we have the presentation as well? All right.
Okay, good afternoon. I think the presentation fitment may be a bit of an issue. I'll keep it crisp. So what I will start with is discussion of where we are. So the COVID disruption in the economy was it created a lot of waves. So we first saw a sharp dip down, then we saw a pickup. Where are we, right? And how close can we get to the pre-pandemic path? Then we will look at what the medium-term growth paths for the economy can be. We will then discuss. Okay, so this is easier to read for me, but not for you. So we'll stop. We'll then discuss some of the global risks that we see on the horizon. So if you see the left-hand side chart there, there is, you see an orange line, that is the trend line. So if you see the quarterly GDP, when detrended, takes a certain trajectory. This is definitely a forecaster's friend. This is how forecasters like me tend to have, a very, very narrow band of forecast for the collective output of 1.4 billion people. Now, when the trend line breaks, so what you see on the right-hand side chart is the gap versus the trend line, so the quarterly GDP versus the trend growth. And what you see there is that there is a sharp breakdown, and then it becomes very difficult for forecasters to figure out where the economy will reach. How close will we get to the pre-pandemic path, and what will we do after that? So you see among the consensus forecasters, the right-hand side chart, the line which is drifting away, it suggests that current expectation is that GDP growth after the pandemic will be slower than the GDP growth before the pandemic. So the output is going to start is the 3-year CAGR. So now the pandemic is 3 years old, or was 3 years back. So we have to go back to December 19 quarter and look at December 22 quarter to see what the growth rates look like. So what you see where the circle is, the oval is, that's the GDP growth expectation. That GDP in December 22 is going to be very much the same as, or was very much the same as GDP in December 19. Whereas if you do the 3-year CAGR for e-way bills, for rail freight, for four-wheeler sales, for steel demand, cement demand, everything is stronger than that number. And which suggests that the underlying economy, because whatever the NSO, the National Statistical Office, calculates, the underlying economy is what you and I are much more interested in. So the revenue growth for you, the revenue growth for your investing companies, and the market returns that we expect. We've also done an energy proxy. You can't grow GDP without growing energy. So the criticism of the left-hand side chart is that it only captures the upper income segments and also the formal segments. So what we've done on the right is looked at total energy demand. You can't grow GDP without growing energy. So if your energy demand is growing at 3-4% CAGR, GDP is definitely growing faster than that because energy efficiency keeps improving every year. The next challenge for the economy, and this is global economies, every economy went through this, is what is fashionably called the K-shaped recovery. That part of the economy is doing very well, part of the economy is doing very badly. My assertion, backed by these charts, is that that is now starting to normalize. So what you see on the left-hand side chart, you see the blue bars. So there are 4 quartiles. This is for the US, but our assumption is that this will apply also to India and China and every other country. When you lock people down, what you do is you constrain the consumption of services by the rich, because it's mostly the rich who consume services, like travel, restaurants, coaching, tuitions, home services. Now what you see is that that becomes lost income for the bottom half. So it is not surprising that when the economy opened up, the rich were left with a lot of savings and the poor were left with a lot of debt. Now, as if some dam had been opened, so the moment you open restrictions, that money starts to flow. So what you're going to see is that the lower income segments start to see income growth, and that is exactly what is happening. You see the rightmost chart is the NREGA demand, the demand for the National Rural Employment Guarantee Fund, and that is our proxy for unemployment. So what has happened is that the NREGA demand is now falling to pre-COVID levels. Sharply up, this is like the e-commerce penetration in the US. So it went sharply up, and then there is a sand dune type shape where you see a sharp decline towards the trend and then slowly asymptoting to the trend line. And that's exactly what's happening, but on an year-on-year basis, what you will see, and you must have seen the commentary December quarter and some recent commentary from consumer companies, that the sales have been very weak. But I don't think that's the sign of a permanently weak economy. Why am I so constructive on growth being faster than what it was pre-COVID? Because of several points that I'll run you through now. The first is macro infrastructure. So you look at the highway length completed. This number is going to be above 16,000 kilometers this year just by NHAI, and then the Ministry of Transport also does the border roads, etc. So this number is still rising. Expressways, which are under construction, so Delhi to Chandigarh in 2 hours, Delhi to Dehradun in 2.5 hours, Delhi-Mumbai in 12 hours, which it takes 24 hours. These are remarkable changes in on-the-ground infrastructure. So it will start to make a lot of sense. Till now, if you want to do something for exports, you have to be in Bombay. You have to be close to a port. 2 years, 3 years later, you can actually have a lot of freedom in choosing where you want to set up your port capacity. There is also micro infrastructure. So you can see in the water pipelines, so there is a lot of debate around female labor force participation in India being very low. It is, and there is, I think, a calculation problem and a benchmarking problem, but I think the numbers are indeed something that we need to work towards. Now, what has changed in the last, I would say, 5-7 years is a remarkable change in access to piped water, access to dense forms of energy, which you see on the right-hand side chart. So that saves a lot of time at an individual household level. I don't have those charts here, but you look at broadband penetration. Remarkable changes happening. We always thought we would remain stuck at 2% penetration, but those numbers are also starting to change. So you have improvement in macro infrastructure, improvement in micro infrastructure. You also have digitization. There are now new use cases you must have seen and heard of, like parking payments, or I would be surprised if we have hardly ever put in a meter for congestion. And so these are remarkable things that can significantly improve productivity at a unit level and therefore drive macro growth as well. Some of what you do is absolutely critical for the development of the Indian economy. So the Indian economy, remember that we are still a low middle-income economy, lower middle-income economy, with per capita GDP still in the $2,000-$2,500 range. A low middle-income economy, lower middle-income economy, with per capita GDP still in the $2,000-$2,500 per capita range. Now, at this stage, availability of risk capital is a huge problem. So if you've heard of the story of, and there's a nice book on it now, Hudson Agro. He started in 1971 with being an eye candy seller with 13,000 rupees of capital. He reinvested his savings, accrued savings, and then over 50 years made it a $2.5–3 billion company. Now, if you can get capital early, you can get risk capital early, it actually accelerates that growth. And I think the fact that if you see the left-hand side chart, that private capital has exceeded public capital is, I think, a remarkable change in India. And it has significant impact. And you can see, I mean, of course, these valuation percentages would have come down now a lot more. But in India, it matters a lot more than it does to the US. Because in India, there are like tens of thousands, if not hundreds of thousands of micro enterprises which need 20 lakhs, 50 lakhs, 1 crore, 2 crores of capital to really scale up. And then, of course, the rest of you can take care of it. The real estate cycle is turning. And I think this is something which is underappreciated on how bad it was for the Indian economy. The fact that in an economy where the number of households is growing at 2.5% a year, where the size of a house needs to grow at 4% a year. Just for perspective, in India, the square footage per person is about 100 square feet. In the US, it is 700. In China, it is 550. So there is significant expansion of floor space that needs to happen. The challenge, of course, is that despite that, we saw, if you see the left-hand side chart, the red line, the gross value of output of construction actually fell by almost 5.5% points. This was a drag on GDP growth of almost 1% point a year for nearly a decade. And this cycle is now starting to turn. And you can see why it happened on the right-hand side chart, that price increases just stalled. And now all of those changes are starting to happen. So I think that, and this is the point I had, that you see the right-hand side chart, that is the affordability index. What happened in 2012-13 was so ridiculously low. Affordability has improved, and that was the drag on GDP growth that I'm talking about. Economists like me, who've been tracking the economy for many, many years, we had almost given up on India's manufacturing skill sets, that India would ever be able to do well in manufacturing. Guess what? We have now started to show remarkable progress. Just to give you some numbers, on mobile phone exports, we did 45,000 crores in FY22. We're likely to do 75, 80,000 crores this year, and 1,40,000 crores in FY24. And these are industry forecasts. So similar things are starting to happen in chemicals, in auto components, in apparel, where we had almost 1,000 crores this year and 1,40,000 crores in FY24. And these are industry forecasts. So similar things are starting to happen in chemicals, in auto components, in apparel, where we had almost 1,000 crores this year and 1,40,000 crores in FY24. And these are industry forecasts. So similar things are starting to happen in chemicals, in auto components, in apparel, where we had almost 1,000 crores this year and 1,40,000 crores in FY24. And these are industry forecasts. So take a ratio of inflation by nominal GDP. The red line there is GST to GDP ratio. It is up from 6.3% pre-COVID to above 7% now. The same is starting to happen with direct taxes. So direct tax as a percentage of GDP. So our tax compliance, our formalization is actually starting. And this is remarkable. This is very important. It's almost like in a housing society, suddenly the maintenance charges are going up a lot. So the upkeep of the housing society can then start to improve. And this is very important for the country. It's happening for state governments as well, right? So, all of this actually starts to flow to the states as well. Now we come to the challenges. I think the near term, in the next 12 to 24 months, I think the challenge is going to be that our exports fall a lot more than our imports, and that creates a problem of balance of payments deficit. So if you see the right-hand side chart, that's the shortage of dollars. In a young economy like ours, where we need external capital, if we don't get enough external capital, we start to slow down. And if we can't have exports, then our ability to pay for the imports of energy that we need, we don't have any dense energy, it becomes a big problem. So last year, the problem was energy costs were very high. Now energy costs are coming down. But now our exports are falling as well, and there is a problem with capital flows. So if you see the right-hand side chart, that's dollar bond issuance by Indian companies. And the red line is the rolling 12-month number. At one point, this number on a rolling 12-month basis was $26 billion. It is now 6, and I won't be surprised if it falls further to closer to $2 or $3 billion. So suddenly, this high-cost debt that is coming through globally has slowed down the availability of dollars. And There are many drivers of that. So the RBI is trying to offset that by depleting reserves, but I don't think that's really going to play a very important role. I'll skip this in the interest of time. Inflation, if there are questions, I'll be happy to address them. In the markets, in the stock markets, which I'm very familiar with, and for you, that is the common mode of exit, there is a tug of war going on. So there are unintended buyers in the domestic market, and there are FIIs, foreign institutional investors. So what you see on the left is the blue line is rolling 12-month investment by foreign investors. The red line is rolling 12 months for domestic institutions. So they've been buying, the foreigners have been selling. The right-hand side chart is the stock of that. So the ownership of FIIs is falling, ownership of DIIs is going up. And this is happening mostly because of unintended buyers. So when you and I pay for there's some deduction into a provident fund, that money is actually going into equities. Part of it is going into equities. When you see SIPs, that money, the person saving is actually saving it for just beating deposits. But I think the challenge is, I was given 15, I thought it was for 20 minutes, I'll take 5 minutes more. So the challenge now is that there is this wave of money coming in. So if you think about guaranteed funds from insurance, you think SIPs, you think EPFO, there is $30–35 billion of annual flows into equities, which is keeping equities very expensive, and which is forcing the FIIs away because India looks so much more expensive than the rest of the world. You see the right-hand side chart here? The blue line is India's PE premium, price to earnings premium, to the rest of the world. It had reached 60%. It has now come down, partly because of the valuation correction of Adani stocks, partly because China has rebounded, partly because Europe has rebounded. But the stock market, in our view, will keep grinding lower. This is what has happened to the world. So I'll spend the next 2 minutes on global risks. You see the left-hand side chart and focus on the gray bars, right? So this is the distance from the 52-week high. So these markets globally are assuming that the worst is past us, right? So they're now starting to pull back up. Their assumption is that interest rates will fall. You can see that number is now starting to change. The right-hand side chart is the market expectation of Fed funds in December 23 and Jan 24. And what you see is that those numbers are now at record high levels again. Record meaning 15-year highs again. And this, I think, is a huge challenge. The left-hand side chart is one of the most fascinating ones. This was done by Ben Bernanke, if you remember, he was the Fed chairman when the financial crisis occurred. In a paper in 2018, what he highlighted was that the gray line, which is the flattish line that you see, would have been the trajectory of the US economy if panic had not set in. That is, a financial market accident had not occurred. It was the orange part, which is the panic factors, which drove the decline in GDP, which is the blue line. Now, the assumption everyone is making is that we go from one hill to the other hill. So we are here, we go here. Because, economics is self-adjusting. So you have high inflation, you raise rates, inflation falls, rates can fall. The problem is that in between, there is a valley. And it could be, in Hindi terms, in much more scary word, high, right? And that who survives that is actually the challenge. And so I'll just run through a couple of points on what I'm worried about. So you see, the rates this year are going to remain high, and which is, I think, a problem for all of us, a challenge for all of us. That rates, central bank rates, this is the weighted average central bank rate, the left-hand side, going to remain at 15-year highs, at least for the course of this year. The second is the quantity of funds. That's the cost of funds. The right-hand side chart is the quantity of funds. So the broad money stock, or the money available in the global economy as a percentage of global GDP, was rising for most of the last 15 years. For the first time, it has started to correct, and it is now below the trend line, and it is back to 2017 levels. So there is less money, and it is costlier money. It is not very good for assets. What has happened in the last 15 years is that you see the left-hand side chart, as the rates kept falling, the capital structure of corporations started changing. So if you have lower cost debt, you can afford to take more of it. And so they've taken more of it. The second is that if you see the right-hand side chart, the ratings. So triple B is the last investment grade bond. Triple B bonds are now 50% of outstanding investment grade credit in the US. You can see one downgrade away, and then suddenly they're uninvestable for insurance funds, uninvestable for pension funds, uninvestable for mutual funds or some mutual funds. And therefore, the disruption can be quite stark. What it has also done, the low interest rates, is that asset prices have gone up. If you see the left-hand side chart, the red line, that is global wealth to global GDP. It was 3.7, 3.7 in 2010. It is 4.9 now. So as rates go up, I think wealth will start to erode. And the biggest problem is going to be real estate. Globally, real estate prices, if you see the right-hand side chart here, that is the mortgage rate in most of the large economies. You can see how sharply they're going up. You see the right-hand side chart. Real estate prices are, the 2-year CAGR is at 30 to 50-year highs. We have not seen these levels of growth for a very long time. These are not, and they don't just stay there, right? So they will then, followed by a drop in growth. You see the left-hand side chart? It is very important. House construction, just like I said, India's real estate cycle is recovering from a 10-year down cycle. There are some economies, just half a minute, some economies where it is correcting after a 15-year up cycle. So Australia, Canada, Germany, they've not had a real estate down cycle for 15 years. And that's how important they are. In China, it's 15% of GDP. So if it starts to slow down, it brings down the global economy as well. This is what real estate construction has been. So on that count, I will stop. I don't know if there is supposed to be any questions. I guess we're already over time.